So in this chapter we'll be discussing about the Asian financial crisis. This is one of the another crisis. So in 1980s, the Southeast Asian countries like Thailand, Malaysia, Singapore, Indonesia, Hong Kong, South Korea, they grew by very impressive rates as high as 6 to 9%. This was the period in which India was not growing that fast. Okay, our economy was opened, became the liberalization was in 91. So the entire decade of the 80s belonged to the Southeast Asian nations countries where they were growing at a very rapid pace, close to 6 to 9%. So these countries were very good at exports because the labor was cheap. They adopted friendly policies, investment policies, reduced barriers to international trade, and in some countries such as Malaysia, heavy inward investments by foreign companies. So what happened due to all this export-led growth was there was this investment boom in commercial and residential property, industrial assets. Okay, so the value of commercial and residential real estate increased very rapidly, and banks lent heavily to such sectors. Industries also expanded, and there was a sort of overcapacity in the system. So all these investments were made on the basis of the future demand projections that everything will be in positive in future also. So this led to significant excess capacities. So how do companies make this investment? They had to borrow money. Okay, so much of the borrowings were in US denominated debt instead of local currencies because interest rates on dollar borrowings were cheaper than domestic currency borrowings. So that is the key point. Okay, the local currencies of this country at that point were pegged to dollar. Okay, what do you mean by pegged to dollar? So this is the exchange rate was fixed to the dollar in the sense that if the dollar moved up, this also will be moving up. Okay, so this is not free floating. This is not as per the market demand. Okay, this is pegged to the dollar. So as long as the local currency is pegged to the dollar, things will be fine in a way because there will be this natural movement. However, if the governments could not maintain the dollar peg and their currencies started to depreciate, this would increase the borrowing cost and result in companies default. Okay, so companies kept on importing a lot of capital equipment because they were in this expansion mode. They started importing capital equipment, building infrastructure industries, and due to rising imports, current account deficit kept on increasing. We discussed about current account deficit in an earlier chapter. Okay, so by 95, Indonesia's current account deficit was 3.5% of GDP. Malaysia's was close to 6%. Thailand 8%. So with such high deficits, it was becoming increasingly difficult for the governments to maintain the peg of these currencies against US dollar. Now this peg system might be a bit confusing to you, right? So you do not go into much depth into it. It's an advanced topic, but let us see briefly what is the actual crisis. Okay, so against this background of excess capacity in the system, events followed. So first in February 97, a Thailand property developer announced that it had failed to make a scheduled interest payment. That was a big loan, $80 billion Eurobond loan. So it was defaulted. Later it was clear that not only that company but many other Thailand's financial institutions were on the brink of default. So one of the starting points of this crisis was this attack on Thai baht. So let us see what was this Thai baht. Okay, and in the process we'll also be having a clarity on the pegged system of exchange rate. So let us see this. Thai's currency was baht. Okay, BAHT baht. Okay, in those days Thai baht currency was pegged to US dollar at an exchange rate of around $1 is equal to 25 bahts. Okay, so a fixed exchange rate, sometimes called a pegged exchange rate, is type of exchange rate where the currency's value will be fixed against the value of another currency. So in this case, Thai's baht is pegged to the dollar at the fixed rate of $1 is equal to 25 bahts. But there are currency traders. So in the market, in the forex market, there will be some traders who knew or who expected that the baht will fall because the country's current account deficit is increasing day by day. Okay, so they all knew that why is the current account deficit more? Because the demand for the dollar is more. So people were importing a lot of capital equipment and there's a lot of investment. So because of the demand for dollar, they knew that the value of baht will fall. This is inverse. Okay, if the demand for dollar is more, it means corresponding the demand for Thai baht will be less. Okay, so they knew that the baht will fall one day. Okay, it would have fallen definitely, but the government is artificially holding this exchange rate at $25. That 25 bahts, $1 is equal to 25 bahts. That is the whole point. So if this is the key point. Okay, had the normal market forces determined the exchange rate, the value of baht would have fallen. So instead of $1 is equal to 25 bahts, it would have been 30 bahts or 35 bahts. Okay, But because the government is artificially holding this exchange rate because of this pegged exchange system, that is not falling. So they used to do what is known as short selling. We discussed this short selling in the context of stock market earlier. Okay, so here also they applied the same concept of short selling. Short selling means selling a security even though you don't have it. So how they do it in the stock market? So you borrow from the funds from the broker, borrow the stocks from the broker, and you sell the stock with the expectation that the stock price is going to fall. You benefit only if the stock price falls, because then you can purchase at a lower price, give back the stock to the broker, and you pocket the difference. That's the profit. But in case instead of falling, the price increases, goes up, then you'll be at a huge disadvantage. Okay, so in the same way, the currency traders in that case started doing short selling. So what they used to do, they used to borrow baht, the Thai baht, from banks, and immediately sell that baht in the forex market for dollars. So why? Because they knew that if the value of baht falls, they will profit. For example, say a trader, what they used to do, they used to borrow say 500 bahts from a bank, from a Thai bank, 500 bahts for a period of 3 months. Okay, they borrowed 500 bahts from a bank for 3 months. Means after 3 months they have to pay back 500 bahts to the bank. Then the trader would go to the forex market and exchange this baht for dollars. So because the peg rate is 25, he'll get how much? $20. Okay, one dollar is equal to 25 bahts. So if he gives 500 bahts, he'll get $20. Their logic is that since they're expecting the value of baht will fall in future, so if baht values declines, say for example to say $1 is equal to 50. Okay, so then what they can do, they can repurchase that 500 bahts for just $10, isn't it? Because now the exchange rate is 50, they can get back that 50 bahts for just $10. So then they'll repay this 500 bahts to the bank, and in the process they'll make a profit of $10. This is not short selling. This is the entire concept of short selling. But all this is assuming that the value of baht will fall, but the government is not allowing that. Okay, it's artificially holding the value at 25 bahts. Okay, so a kind of war followed. Okay, short sellers were attacking the Thai baht, and to defend the peg, Thai government was using all its forex reserves to purchase the Thai baht. Okay, how will government artificially peg the rate at 25? It has to use its forex reserves. Okay, so in doing this, what happened was the forex reserves kept on decreasing, and at one stage it became impossible to artificially hold and defend the baht. So then in July 97, Thai government announced that they'll allow the baht to float freely against the dollar. So immediately Thai baht has lost 18% of its value, and in fact by Jan 98, the exchange rate slipped to $1 is equal to 55 from 25. You see, this is more than 50% decline in the value of baht. What this meant was the dollar debt, for example, say somebody had taken a debt of $1,000, now they had to pay $2,000 because most of the debt was in dollar denomination, which we discussed earlier. Okay, so then the Thai government approached the International Monetary Fund for help, or else the value of baht will fall even further. So IMF again agreed to give the loan, but put conditions like increasing taxes, privatizing several state-owned businesses, and raising interest. Then following the devaluation of the baht, again that hit the other Asian currencies as well. So Malaysia let its currency, the ringgit, float freely in 97 July. Before devaluation, the ringgit was trading at $1 is equal to 2.525 ringgit, and within 6 months it declined to $1 is equal to 4.15 ringgit. In case of Indonesia, the currency rupiah fell from $1 is equal to 2400 rupiah to $1 is equal to 10,000 rupiah within 6 months. That's loss of 75%. Singapore dollar also was affected. Okay, so in summary, what this crisis is all about is a series of currency devaluations that spread throughout the Southeast Asian countries in 97. So it first started in Thailand when the government decided it's going to no longer peg the local currency to the US dollar, and that currency decline spread throughout the other neighboring countries in South Asia. So the factors that the main causes for the crisis was excess investment, high borrowings mostly in dollar denominated debt, and deteriorating balance of payments position. Okay, so in this chapter, the only thing you have to remember for interviews are what were the factors that were causes for the Asian financial crisis. Okay, so the factors were high borrowings in dollar denominated debt and the very high current account deficit, the deteriorating balance of payment position.